One of the things that makes our Squirrel peer-to-peer lending platform unique is our use of reserve funds that help protect investors from future expected credit losses. In the event that a borrower defaults or misses repayments, the reserve fund kicks in and makes sure that the payment back to the investor is still made, thereby protecting the investor from losses. The benefit of the reserve fund model is it gives investors the ability to fully diversify their risk across all loans in that investment class on our platform so that they don't have to worry about the credit risk of an individual loan. Each of these investment classes have their own reserve fund. So when you're investing into that class, you're only exposed to that class. You're not exposed, if you're investing in home loans, you're not exposed to personal loans, and you're certainly not exposed to the business property loans. The return that you're getting is commensurate with the risk of that product, but they still all have these reserve funds, and part of the borrower interest is going into that reserve fund to cover future expected credit losses. So how could a reserve fund run out, and if it did, what would happen? You know, when we're looking at credit risk, we're looking at a whole range of factors, including the probability of default, you know, whether or not someone's going to stay employed or they could lose their job, and then loss given default. In the event that a borrower defaults, what's our ability to recover that money? Obviously with secured loans like home loans and business property loans, we've got a much better probability of recovery, particularly if the loan is relatively small compared to the value of the property. You would expect your losses to be negligible, if at all. Whereas with the consumer finance personal loan type products, your losses can be higher because your ability to recover the loss in the event of default is a lot lower. And that's what we see in the returns. So we're looking at the economy, we're looking at the unemployment rate, we're looking at what's happening globally. We're also looking at what's happening with the underlying portfolio and what the trends are in terms of the credit losses that we're seeing. This all helps us set the level of reserving that we do so that we have enough in reserves. The reality though is that there could be a situation in the future where that's just not enough, and we have to put the reserve fund into active management. Active management is where our socialisation clause kicks in. It gives us the ability to divert part of the borrower interest that they would normally receive into the reserve fund so that we can build up additional reserves to cover expected credit losses. That way investors are losing the interest that they would have got, but we're pushing more into a reserve fund to protect them against any future capital losses. That's how it works. We're not going to wait for the reserve fund to run out of money before we put it into active management, because we're going to get some clues as to what we think the future expected losses would be. So in the event that the reserve fund is running down, we've had some sort of macro event or some big spike in credit losses that has us worried, we will push that investment class into active management. It's all about making sure that we're acting in all of our investors' best interests. So we've designed our platform to give you stable and predictable returns and to reduce your risk as much as we can.